guys, welcome to another YouTube video in my accounting classroom. Today we'll be doing how to draft a financial statement, and that financial statement is balance sheet, and I'll be doing journal entries in part 2, but let's just focus on balance sheet for now. Now as we can see on the screen, there's a question and I'll be doing it. It says draw up A. Foster's balance sheet from the following as at December 31st, 2001. Now, what are the components that are in a balance sheet? We have assets, equity, and liabilities. Now, your assets, total assets must be equal to your total equity and liabilities. First, we want to create the heading. Now, what do we need to create the heading? We need the name of the person or the organization. We need the type of financial statement, and we need the year-end close. Now let me just start by
putting that in. So we have to put in the name of the person or the organization. I'm doing it from scratch.
hope you can see. So we have A. Foster's. We're doing his balance sheet. These are really important. Never you create a balance sheet or a financial statement without doing the heading. And for balance sheet, we have as at year-end close, which is December 31st, 2001. Let me just bring this down a bit. The next step is this step that I'll be outlining will be better for you when you're creating these. So the first step is creating your heading. The second step is identifying those items that are in the question, trying to group them in what category, like which one of these are assets, which one is liability, so that you can know where to put them in the balance sheet. So let me just go right back to this. We're gonna make a note of the ones that are equity, ones that are liability, and the ones that are assets. Now for assets we'll put a, equity we'll put a E, and liabilities we'll put a L. Alright, let's get started. Capital. This is our equity.
No, I don't like that. So capital is equity. Put that E. My E is also. Debtors. Debtors is assets. And what type of asset is it? It's a current asset. Starts with CA. Motor vehicles. Fixed assets. Creditors. This is a liability. It's a current liability. Fixtures. Fixed asset. Stock of goods. Current asset. Cash at bank. Current asset. That's out of
We'll be doing our financial statement because we have the heading and we know what these items are. Let me just a little bit. Alright. Okay. So now that we can see full screen, let me just bring this over just a bit so you don't feel lost. And we start our balance sheet with fixed asset items. Now the two fixed asset items, fixed assets, the two fixed asset items that we'll be putting in will motor vehicle and fixtures. So let's just put them in. And we're putting in the amount same time. And we know that if our balance sheet is not balanced, if our assets is not equal to our equity, equity and liability, something is wrong. So let's just do this in the first go and see how accurate we are. Current assets, we have the debtors of stock of goods and the cash at bank. Now our total asset must equal to our fixed asset plus current asset. And now that we know the total assets, we know that our equity and liability must be equal to this total. Ensure that you bold and not bold your writing. Ensure you double line your final figures. So let's start with equity. Let's put the heading first. Capital, which is this is 23,750. We don't have any more equity, so let's go with the current liability. And that current liability we had was creditors, right? 2450. So we have all items. So we need the total equity and now that we have all items, this figure that we're going to calculate now should be equal to this one. Let's see. And it is equal. So we got this statement right. Now, as I said, when you're doing your balance sheet, you start with your headings and try to identify the items in the question. What account do they fall under? Are there assets or current liabilities or equity or liabilities? Knowing that, then you will know where to put them in the balance sheet. You know that your total assets must be equal to your total equity and liabilities. So putting them in the right section should allow you to have your balance sheet balanced. In part 2, you'll be seeing me again talking about journal entries. So just stay tuned, guys. I hope you learn a lot from this one. Just remember to underline where you're going to do the total. You put an underline in the item above. Ensure you double line your final figures. Ensure you underline these headings. So these headings, ensure you underline them. Fixed assets. And I will see you guys in the next video. Hi guys, we're here again, and this is part 2, and we're doing journal entry. This question, this one doesn't have any figure in it, but we have the accounts, and once we know what type of account and how to treat them, then we should be able to draft a journal entry, a T account. Now let me just do this. We have the debit and the credit side. And if you look at my video, like the first one, it gives you an idea of debit and credit. So I won't speak about it again. I'm just going to go right into the question and get it done and explain while I do such. It says that complete the table and tell which account should be debit and which should be credit, right? Alright, so we're taking it step by step. question said it bought a motor vehicle for cash. And I said in the first video that assets, expenses have a debit nature. Motor van is an asset. Cash is an asset also. But I also said it depends on the nature of the question. If we are buying something and it's the motor vehicle that we are buying, then we get to keep the motor vehicle, right? But we are paid cash. So we are getting something. What is it that we are getting? It's the motor van. What is it that we are giving out? Cash. So we would debit the motor vehicle, credit the cash account. So that's for number one. So cash is reducing and we are getting more assets. Now here's another one that is similar. Bought office machinery on credit from J. Grant and Son. Now the two items that we are trying to classify is office machinery and J. Grant and Son. Office machinery, we bought it, we are getting it, debit. Office machinery is debit. J. Grant and Son. Who is J. Grant and Son? As in, yes, it's an organization or a person. But what would you call them? They are the creditors. They are the people that we owe. So J. Grant and Son is creditor. So the J. Grant and Son, which is creditor's account on our part, would be debited. So we are owing more. And the fact that we are owing more, I also spoke of that in the first video, that if we are trying to increase an account that has a credit nature, and this is liability, so it has a credit nature, and if we are increasing it, there's a bike in the background, if we are increasing it, then we would credit it. So we are increasing our assets because we're getting an additional asset, and we are also owing more. We introduce capital in cash. Capital has a credit nature. We are getting more capital and we are getting cash also. So we would credit the capital account, debit the cash. So we are increasing it. Cash is an asset, so it has a debit nature. Alright, I hope you're getting what I am saying. I hope I don't get you lost. A debtor, J. Beach, pay us by check. Alright, let's say it again. A debtor, J. Beach, pay us by check. What is increasing on our part? Our cash account, cash and bank account. So we're getting check, money, more money in our account, so increase. But our debtor is paying off their debt. And the fact that they're paying off their debt, even though a debtor is a debit nature account, and we are reducing their debt, it should be credit. So J. Beach, who is a debtor, we credit their account and we are getting check, which is more money. So we debit our account. Alright. Let's see cash at bank. Our bank. Alright, same thing, cash at bank. We paid a creditor, A. Barrett, in cash. Paid a creditor. If we are paying a creditor is persons who we owe. We are paying them, we are reducing our debt. However, we are paying them in cash, which means we are also reducing our cash account because we're taking out money from the cash account to pay them. The cash account is an asset, it has a debit nature. If you're trying to increase a debit nature account, you debit it, but if you're trying to decrease it, you credit it. We are decreasing it in this perspective, so cash is credit. Creditor has a credit nature. You're trying to decrease your credit, your creditor's amount. If you're trying to increase it, you would credit it because it has a credit nature, but the fact that you're trying to decrease it, you debit it. I hope you guys understand from this perspective. I honestly don't think I was taught this way in high school, but I hope that it helped a lot and it shows what account and which side they go on, whether they should be debit or should be credit. Now guys, thank you. I have more videos coming up. These videos are on balance sheet and double entry. I hope that it helped you a lot. I hope that it allow you to understand more and look at these questions from a different perspective, and I have an easier way how to approach them. Thank you guys. I thank you for the support. Again, continue to comment, continue to like, continue to send. I will put my email address in the bio, so just send me emails on questions and I will get them done for you guys.